Hello, everybody. My name is Tony Lajeunesse, CEO of TL Financial Group. Hope you are all doing well today. Today's presentation is in listen-only mode, but we are recording it. So there'll be a recording for you to view this at a later date or to share it with somebody else if you'd like to do that. Today's presentation is the year in review and a look ahead, 6 planning ideas for 2021 and beyond. There's a lot of information into today's presentation, so if you have any questions for me, as always, please feel free to reach out to me, call me, or send me an email. We are now going to go ahead and start our presentation. All right, so as we prepare to close out the year, and what a year it's been, right? I want to take a quick look back and then provide you some planning ideas for 2021. So we're going to go over the election, we're going to take a look at the market outlook, and then planning ideas for 2021 and beyond. So what is the history of how elections and parties in power have impacted the stock markets? I've gotten many questions on this as to who has the better track record, Republicans or Democrats. And the major market indices, as denoted by the S&P 500 and NASDAQ, rebounded in November, with all sectors finishing higher. Now, most noteworthy is that November was a record-breaking month for equities, thanks to the positive vaccine news and a strong third quarter earnings season as well, along with a likely split in Congress. Now, indeed, November was the best month for the Dow since January of 1987, perhaps lending credence that the long-awaited rotation to value and other cyclical stocks is finally starting to occur. Now, here are some of the themes and lessons from 2020. One, COVID-19, of course. According to JP Morgan Asset Management, the average duration of a bear market correction is actually 22 months. The COVID-19 pullback lasted only 33 days, making it the sharpest and quickest decline to recovery on record. Growth stocks held up nicely throughout the pandemic that started in March, returning 31% as of December 1st. And the fourth quarter came around. The markets saw a rotation from growth to value, and cyclicals are likely, as the likelihood of vaccine in 2021 had actually become really quite strong. With regards to volatility, the coronavirus played a huge role in the volatility of the market in 2020. The volatility index, which is also known as the VIX that you see there, it measures the volatility and general investor uncertainty. It reached a reading of 66 on March 23rd, 2020. The last time it was that high was when it was 77 during the financial crisis of 08 and 09. Now, regarding unemployment, 2020 began with one of the lowest unemployment readings ever at 3.6%. As the pandemic hit, unemployment levels reached as high as 14.7% in April, and these levels have not been seen since the Great Depression. Now, with regards to the vaccine, it usually takes years to develop a vaccine. 2020 saw companies such as Pfizer, BioNTech, Moderna, and others to race to develop a vaccine in record time. In less than half a year, phase 3 was reached by these companies with an estimated 90% effectiveness. The market responded favorably to those developments in the fourth quarter. Another big piece of news from 2020 were the presidential elections. Although behind us now, the elections created additional market instability as the markets dislike uncertainty. Now, the markets have been responding well so far to a President Biden and a divided government. And we're going to talk more about that later on. All right, let's go ahead and move on to our economic outlook. Confidence is being restored now that the vaccination is firmly in place. Goldman predicts that Pfizer's vaccine and others will be available to vaccinate the US population by the first half of 21. Facilitating a global recovery. They also estimate that GDP of 5.3% in 21 versus a negative 3.9% in 20. The vaccine and subsequent reopening of the economy are important drivers to Goldman's bullish forecasts. Goldman also further predicts that the S&P 500 earnings will rebound sharply, growing 29% year over year after losing 17% in 20. They also predict the S&P 500 will have a 4% gain to 3,700 in 2020, a 16% return in 21, and 7%, which would bring the S&P 500 to 4,600 in 22. Now, the vaccine should serve as a catalyst for value stocks, but growth remains attractive as underlying fundamentals remain supportive. So consider like a barbell approach here. The economy is only 68% reopened as compared to February of 20, and the recovery is nonlinear, although the vaccination and coming spring are probably going to change this. After reviewing a favorable outlook for the markets, there are some key risks to consider. The 5 largest stocks, Facebook, Amazon, Apple, Microsoft, and Google that you see here, have been the big winners in 2020, some returning upwards towards 70%, and they comprise up to 25% of the S&P 500 market cap, so that's a big number. But they have had 10 years of fast sales growth and trade at 29 on their PE ratio versus 18 for the stock market, and they have lower leverage. So increased liquidity from the Federal Reserve in the way of low interest rates creates wealth before jobs. It also created an additional risk, and that's why we saw the market really go up after April, is because of what the Federal Reserve's significant amount of stimulus that they put into the economy, and they're getting ready to do another one, which we'll talk about in just a little bit. The market has baked in a first quarter vaccine already to its stock market returns. So you see here, China is going to remain a challenge, and the gap between the two parties may not be as wide as many think. The trade policy with China will remain really a contentious issue. President Trump has largely been successful in adjusting how Americans see China. As you see here, the numbers, Republicans 72% view China negatively, and 62% of Democrats hold the same view. And this outlook is going to affect trade, supply chains, and could increase inflation over time, although Biden is likely to take a more tempered and multilateral approach. So we'll see what happens there. But something to watch. The difference between both parties regarding stimulus has been focused on the dollar amount and level of benefits allocated to particular groups. So the size of the next aid package, which is actually being debated right now, it looks like it's going to come in around $900 billion. Goldman predicts that the Federal Reserve won't raise interest rates until 2025, a move that encourages economic activity, but it also increases systemic risks associated with excessive borrowing, which has really been the driver of the market right now. The biggest impact on stock markets is not the president or the party in control. It's the economy, interest rates, and the federal policy. Indeed, the market has an upward bias here. So what is the history of how elections and parties in power have impacted the stock markets? There are lots of ways to look at the data, and most of it doesn't mean too much. But politics are emotional and drive a lot of news, but don't seem to have a dramatic effect on the markets. The market reacts a little worse under a divided government than under a one-party rule. But in any event, markets have an upwards bias and return to over 10% a year, regardless of the scenario. So when one party controlled all 3 branches, the average return was about 14.98%, while a divided government averaged 11.48%. The president is important, but capitalism is actually more important. Some additional thoughts on this. Republican control of the Senate will severely limit potential fully Democratic agendas if that happens from the Georgia runoff. Biden will likely need to compromise on any tax planning bill that garners some bipartisan support. Presidents can have a bigger impact on regulatory aspects like the Department of Labor rules on fiduciary standards or ESG investing, which stands for environmental, social and corporate governance. It will be interesting to watch out for the elections in 2 years when 34 Senate seats are up for election. There are 22 Republican and 13 Democrat that are going to be up for re-election in 2 years. So that'll be something to watch. So Goldman predicts that the US dollar is in a structural downtrend, which bolster earnings for international facing companies and consequently boosts emerging markets. Now, we have the largest debt and deficit outside of World War II. But unlike World War II, where we were able to grow our way out of debt, in addition, we didn't have the will to cut spending, and that's for sure. So either way, taxes will be increasing, and they're going to go up for everybody, people like you and I, folks that have saved their money, invested their own IRAs and the like. Tax planning is always important, but now more than ever, it's really important to review your individual tax situation. This is especially true for those that are approaching the age of 72 and will have to begin their required minimum distributions from their IRAs and 401ks. You'll want to examine the tax consequences now so that you have time to strategize. So please reach out to me if you need some help with this, but we're going to talk more about this in detail as we get further into this webinar. So this brings us to topic number 6, Biden's iffy tax plan. So the Biden tax plan looks to raise taxes by $3.5 trillion. So Goldman predicts that policy uncertainty will decline amid likely government gridlock, but stimulus is still important. So restoring jobs will be job one. So a Biden White House may be in no rush to raise taxes. We may see a broadly bipartisan bill addressing the expiring tax breaks, tax cuts to enable COVID recovery, and tax credits for personal protective gear, and of course, support for broadening supply chains and low income tax credits. Generally speaking, you'd see a minimal impact on taxes on those making below $400,000. University of Wharton analysis is saying less than 1% impact on after-tax income for those people. So for those above 400,000, which is 1.5% of wage earners, Wharton is predicting a 17.7% decrease in after-tax income. And again, most of this being Social Security taxes of a 12.4%. So they'll be paying more with regards to that. A Biden tax plan could include Social Security tax, 12.4 for those making over 400,000. He may repeal some of the tax benefits of the TCJA, which was the Tax Cuts and Jobs Act. And if that happens, that will impact most everybody, and no matter what income level they're in. And we'll take a look at that later on as well. Possibly raising the top rate on ordinary income back to 39.6%, and elimination of the stepped up basis at death, definitely on the table for either party. Also taxing capital gains and dividends at ordinary income rates, which could be as high as 39.6 for those making over $1 million. Of course, there's the possibility of this administration limiting itemized deductions, and then of course raising corporate rates from 21% to 28%. It was actually 35% before the Tax Cuts and Jobs Act took place in 2017. Also, they may install a minimum corporate tax rate for larger companies of 15%. So Biden is promising to do away with a step up in basis at death, and that will meet lots of resistance. So you could be paying tax on appreciated stock, home values, and things like that. It'll be hard to do on many levels for him to accomplish that, but it's one of the items that they're going to try to accomplish. All this is near impossible, though, given the split of the House and the Senate at this time. So we're just speculating here at this point in time, but we have our antennas up and our eyes are wide open on these issues. So whether through Biden or the expiration of the Tax Cuts and Jobs Act, which expires in 2025, we can all assume that taxes will go up for most of all of us to some degree, because we have huge debts, and it's the largest deficit outside of World War II. That's ultimately what's going to cause the taxes to increase, and it really won't matter, I think, which president is governing or which House or Senate is also being governed by each party. So with the backdrop of what we just covered, let's take a look forward at 2021 and beyond, because we need to plan wisely for this. You can see here the 4 elements that will be complicating planning strategies. 1, we've got the election and a split government. 2, we have recent legislation, which was the Secure Act, which eliminated the stretch IRA for most of your beneficiaries. We have the CARES Act, which primarily provided assistance to small businesses and families, and then the Tax Cuts and Jobs Act, which is going to expire in 2025. So we have to be prepared for that. We have historically low interest rates, and those low rates are subject to change potentially before they're scheduled to sunset again in 2025. So let's go ahead and review these 6 planning ideas for 21 and beyond. We're going to review portfolio asset allocations. We're going to understand the need for tax planning, retirement planning for confidence. Estate planning is coming back. There's a handful of issues I'm going to cover with you on that are super important. Of course, the general planning, the tried and true, and don't forget distribution planning and Roth IRAs. Some of these things, as I kind of get into this, everybody, these planning strategies, we wouldn't be considering some of these planning strategies just 2 years ago, but now that all of these changes are taking place, these planning strategies I'm going to be discussing with you now have to be front and center, as you'll see here in just a moment. So now that the election is behind us, we believe it's behind us, and the new year is upon us, let's take the opportunity to look at our portfolio and make any additional changes. So asset location is different than asset allocation, and really both matter. So there are 3 main types of accounts. You've got your traditional IRA, 401k, Roth IRA, and Roth 401k accounts, and of course, taxable accounts like an account in a brokerage account. Unlike taxable accounts, the traditional IRA and 401k are tax deferred, and Roth IRA and Roth 401k are tax-free accounts. So for traditional IRAs and 401k accounts, you have to start taking your required minimum distributions from this account once you turn age 72. And these RMDs will be taxed at your ordinary income tax rate. Therefore, it's really important to prepare for the tax bill that will need to be paid on this distribution. Obviously, the larger your account size, the larger the distribution amount is going to be. If you have a large account, this required distribution could raise your taxes on your Medicare Part B premiums and force you into higher income tax brackets. So this should be examined well before the distribution phase is necessary, and consider strategies that are relevant to your unique circumstances. And we'll talk more about cash flow planning and how important that is later on, especially when it comes to the sunsetting rules of the Tax Cuts and Jobs Act in 2025. We have to be prepared for this, because either way, when you're taking required minimum distributions or just normal distributions, that money is going to be taxed. And so the whole idea here is in 25, we know tax rates are going to go up, and possibly even sooner. So it may be an advantage to start aggressively a distribution phase now from your IRAs, whereas previous years we might not have thought about doing that. But I'm going to cover that here in a few slides, you'll see. So with your Roth IRA and 401k accounts, with so much uncertainty connected with future tax rates, Roth accounts make a lot more sense now for people in high tax brackets or whom are worried about taxes in the future for themselves, their partner, or their children. So it serves as a great hedge against future tax rate increases. Taxable accounts. So this is accounts like a brokerage account. It's just after tax money put into an account, and it grows, and you pay taxes on this account as they are realized. So the reason individual stocks may be more suitable in a taxable account is because of the potential growth that they have, as well as a lower tax rate, for now anyways, for capital gains tax rate compared to ordinary income tax rate, okay? So tax efficient funds like municipal bond funds or funds that generate little or no dividend income like an ETF or index fund, those can also be held in taxable accounts as well. So one of the difficulties is you can't always be perfectly tax efficient because it depends on what your asset allocation is between stocks and bonds is and how much you have saved in each type of account. So you do not want to change an asset allocation strategy that has been working for you just to make the accounts more tax efficient. As with asset asset allocation is also key. So there's a lot of nuances in determining the best strategy because of your life goals, your investment holding period, your current life stage, and prevailing tax laws are all going to affect the overall distribution of your assets and the locations of those assets. And so these items have to be really thoughtfully planned out. And this is the theme that I'm sharing with our clients going into 21 is we really need to examine each of the unique accounts that you have and how to best efficiently manage them tax-wise moving forward. So you're going to hear that a lot in this presentation. You see a lot of graphs as well supporting that. Different tax treatments exist for different investment vehicles. In this very uncertain tax environment, try to direct money to tax-free investments when possible. And you can see from this graph here. And you also have some resources that we emailed to you when you registered for this webinar. And you also have a copy of all of these slides. So you can look at this at your leisure later on. And it's a really nice chart revealing the type of asset allocation and the taxes that are associated with each one. Okay, according to Goldman Sachs, a 60-40, which is 60% stock equities and 40% bonds, Goldman Sachs says that it's estimated to return only 4.2% annually for the next 10 years. Those that simply purchase the index funds may be disappointed in the next 10 years as well. Goldman predicts market returns will be based on earnings growth and not necessarily multiple expansions. So despite rosy short-term predictions, they only predict 6% equity returns annually for the next 10 years, although they predict a 90% chance that equities will beat bonds over that period. Bonds are set up to be a huge disappointment going forward. The bull market in bonds is likely over, as yields are likely to decrease from here due to such low interest rates. So determining your bond strategy for the future is very important. And our opinion, it needs to be very, very strategic. I'm going to cover some of that later on as well. There are 3 asset allocation themes to consider for the future. The quality of bonds need to be taken greatly into consideration. The weaker dollar creates opportunity for emerging and international markets. Small and medium cap stocks are making a comeback. The recovery trade, which includes cyclicals like industrials and materials. And then of course, lastly, what's important are targeted alpha strategies where equity stock selections are screened for risk versus its expected rate of return. So it's a strategic approach. According to Goldman, growth outperforms value when we're in a period of slow growth. Growth has outperformed value stocks since 2006. So the market is paying a premium for long duration stocks, basically companies that have a longer duration of cash flow, which is all of the technology, communication services, and healthcare stocks. Low interest rates will fuel demand for stocks. TINA, you see it up here on the second bullet point, TINA was a slogan often used by the conservative British Prime Minister Margaret Thatcher, which means there is no alternative. So as money is cheap and interest rates are low, that is the oxygen for the stock market right now. Goldman is predicting that consumer discretionary industrials, financials, and communication services will perform the best year over year. Looking at recovery stocks, consider including companies that will benefit from a stronger and reopened economy. Small and mid-cap stocks have a tendency to do well early in the recovery, and it looks like that recovery is beginning to take place. And don't forget, emerging markets and international, which are undervalued compared to the US, will benefit from a weaker dollar. Emerging markets have a different set of opportunities and low correlation to developed markets. 78% of top performing companies in the MSCI index are not US located, and it actually grew to 90% in 20. So for those who may object to international, don't forget, you're buying the company and not the country. The third leg of the stool can be a combination of strategies designed to be non-correlated. These strategies include emerging markets and international with active managers, credit opportunities, environmental or renewables, hedged equity, or long short stocks. These are all the items we take into consideration for our clients and the construction of their portfolios. And these are some of the themes, again, that we're looking for next year in this changing environment. Tax planning is really a year-round activity, and it's so important. Let's take a look. The Tax Cuts and Jobs Act provides exceptionally wide tax brackets that investors should be leveraging, whether for tax bracket management, filling the tax bracket, or Roth conversions, which I'll show you a graph on that in just a minute. You can see the bullet points to take into consideration on this slide. So while we're not CPAs, we can help you with your tax planning strategies and suggest strategies that are customized to you. I have some resources that have been connected to your registration, and there's some great key financial data cards and year-end planning strategies for you to consider while if you're doing your own tax planning. So planning idea number 2, many underestimate the benefit of capital gains planning. 0% capital gains rate is beneficial and underused. Consider using ordinary income to offset itemized deductions and then fill up the bucket with capital gains. This could be complex to do by yourself, so if you need some assistance, please contact our office or your CPA. Never use short-term losses to offset long-term capital gains, but plan to use long-term losses to offset short-term gains. And it's not how much you make, it's how much you get to keep after taxes. A good plan will help you get there. So forego the conventional wisdom. If you're 59 and a half or older, consider withdrawing from your IRAs in low income years or low tax brackets. QCD, or qualified charitable distributions, like a contribution to your favorite charity or church, reduces the IRA balance at no cost and no tax, and actually at no cost, and tax benefit is available even if you aren't itemizing. It's really the most efficient means of reducing income and helps to limit the stealth tax, such as Medicare, Social Security, and deductions subject to your adjusted gross income. So if you're interested in this strategy, please contact us and we can definitely help you with that. But it's getting late in the year to do that, and you can see what the provisions are there for QCDs. You can do up to $100,000 per person, but you can't do it while you're still contributing to your traditional IRA. We've always loved Roth IRAs. Roth IRAs provide tax-free growth and tax-free withdrawals in retirement. And now more than ever, they make more sense. The overall idea is to drive down traditional IRA balances as they are subject to future higher tax rate increases. Remember, the tax cuts sunset in 2025 or maybe sooner. So planning your IRA has never been more important, because we can't avoid the tax, but we can at least plan and avoid higher tax brackets in the future by doing some pre-planning now. If it applies to you, make sure to take advantage of the deferral opportunities, whether through maxing out your IRAs or qualified retirement plans, Don't forget spousal IRAs for the added deferral opportunity, as only one spouse requires income to make the spousal contribution for both. But there's some limitations there, and you can find that on the key financial data form, or you can just call our office if you need help with that. Always consider Roth 401ks, as over 50% of employers now offer them. Make sure you review your benefits booklet to determine precisely what is available to you. All right, thanks to politics, shifting tax laws, the Secure Act, and the sunset of the Tax Cuts and Jobs Act, estate planning is front burner again. There are lots of reasons to be engaged in estate planning, tax and otherwise, although many neglect this important area. And the whole idea is, what they say is, they say use it or lose it. Here are some estate planning items to consider. Some of these items that we most likely would have not considered just a couple of years ago, as I mentioned earlier. So it's really important to understand what estate planning objectives are going to be relevant to you. So please consult with us if any of these stand out to you. Don't forget the basics. Has your estate plan been updated? Do you have the critical documents that you need, like your will, your power of attorney for financial, and of course your healthcare power of attorney, or any necessary trust? Those items are so important. Do you have the proper executors and trustees listed? And are your beneficiaries updated? Here are some things to consider. Do gifting now if there's a high need for the goal of helping your heirs with medical expenses or tuition. Low interest rates make the leveraging of the gift even more attractive. There'll be tax increases in the future. You can count on it. So consider the planning objectives under the Post-Secure Act. These items should be reviewed and possibly change the way you strategize your estate planning objectives. Consider state taxes as well. Should there be a relocation? Should you move to Texas like a handful of billionaires are? They're moving out of California and moving into Texas to pay lower taxes. Low asset valuations may exist within the portfolio, which may recover. So gifting at the lower amounts now might make actually better sense. And again, please contact us if you need assistance with all of these planning objectives. It's challenging to go alone on some of these things. In the middle of all the activity, don't forget the tried and true. By definition, planning is trying to see around corners, and your tax preparer is typically not doing this type of work. A good financial planner and financial planning firm can be a big help here. For net unrealized appreciation, ask 3 questions if this applies to you. Is there company stock in the plan? Like, do you own the company stock inside a qualified retirement plan? If it's highly appreciated, is there a triggering event such as retirement where you can take advantage of NUA? Everyone needs a plan, and the question is, do you have one? When was the last time you reviewed it? And are you on track to meet those financial goals? And lastly, don't forget about distribution planning and Roth IRAs. Roth IRAs remain one of the best ways to create multi-generational income tax-free wealth. And with taxes on the rise, there's never been a better time to consider a Roth. It's simple math. Lock in lower rates now to prevent higher taxes later on. It's inevitable that tax rates are going up in the future, and you should be prepared for that. Roth conversions make sense in a number of situations. For example, a widow in a low tax bracket who can convert and then leave a Roth IRA to her children who are in higher tax brackets, or a widow who has one child and is concerned about the taxes the child would pay when they inherit the traditional IRA under the Secure Act. It used to be that your children could inherit your IRA and stretch out their benefits over their entire lifetime. That is no longer the case now. Your children, only under certain circumstances can people do the stretch IRA over the lifetime, but it's very slim. Most of you will, your children, when they inherit your IRA, will be forced to spend down that amount over a 10-year period of time. If they don't pay it all within that 10-year period of time, they pay a 50% penalty on the amount that's left in the account, but they only have 10 years. So they no longer can stretch it over their lifetime. And so for many people who were planning on that planning strategy, all of that has now changed. Sometimes practitioners complicate this. Don't. Roth IRAs allow you to lock in current low rates and to create lower taxes in the future, as your balances will be lower. If you're married, filing jointly, possibly convert as much as needed to stay, let's say, in the 24% tax bracket until the first spouse passes. If not enough time, then consider buying life insurance, as it's income tax free and estate tax free. So you see here from this bracket, this is a graphic of how tax bracket management system would work, or how to fill the bracket. So very wide tax brackets, thanks to the Tax Cuts and Jobs Act, the TCJA. However, those are going to be going away in 25 or possibly sooner. So tax rates are historically low, but they're going to be gone. So 37 is going to move to 39.6. So if you're still in the 12% tax bracket, you can see this dark line where it says current taxable income, and this individual is in the middle of that 12% tax bracket. Easy conversion target that you see there in purple. You just pull money out of your IRA or 401k to fill that tax bracket and to stay within the 12% bracket. Possibly move it all the way up to the 24% tax bracket. And you don't want to go too far, because in some cases you could trigger Medicare Part B premiums. You would raise them on yourself. So if you go too much, you could actually hurt yourself tax-wise. So everybody's situation is different and unique. But what we're illustrating here is the need for that customized approach, so that you know that you're filling the tax bracket as efficiently as you can, and you're moving that money over to an account that is now going to go tax-free and will be transferred over to the next individual tax-free as well. So the key takeaways are this: COVID accelerated macroeconomic trends. The S&P 500 earned 12.5% annually from the day President Obama was elected until President Trump was elected. From Trump's election through October 13th, 2020, the S&P has returned 14.3%. For the politically motivated, the odds are one of these wasn't your favorite president. Yet, stocks did well under both administrations. We believe that the 60-40 portfolio, meaning just 60% stocks, 40% bonds, and then doing a set it and forget it approach, we believe that that strategy going forward is dead. And therefore, the approach needs to be strategic and creative. Now, as we prepare to close here, there are 6 planning ideas for 21 that should be taken into consideration. These, among others, are items that we'll be covering with our clients as we move through 2021. These are all the items that are on our hot button list for all of our clients. Continued portfolio proactive management that aligns with your goals and your risk tolerance. Number 2, the need for tax planning has never been greater. So understanding how they pertain to you and how you strategize is really important for 2021 and beyond. And we have the right tools and software tools to help you make wise, proactive steps here. Retirement planning and cash flow planning is always important, but understanding your income, your Social Security, your retirement planning objectives, and staying on track for your goals should be well defined and written out. Cash flow planning can help assist you by providing a clear picture, which in turn can provide you the confidence that you need for your financial plan. Number 4, your estate planning strategy should be reviewed and analyzed and reviewed for efficiency as well. Number 5, general planning of wills, medical powers of attorney, and financial powers of attorney should never ever be overlooked. So if you don't have those, I would strongly encourage you to get those documents really at any age. Those documents are so important to have. And then lastly, we have to prepare a distribution planning strategy that is customized to your unique circumstances. This should be done in a holistic manner, taking into consideration your health, your income taxes, your estate planning, your Social Security benefits, your investments, life insurance, everything. Again, these are the themes that we're focusing on for our clients in the coming months. If you're not currently a client and you would like to have a private conversation to see if we would be a good fit for you, please contact my office and we can set up some time that will work for both of us. With that, I want to thank you for attending today's webinar. I hope you found this information beneficial. Again, these are all the planning themes that we're going to be sharing with our clients going into 2021, and each of them are very, very important. So with that, thank you again. Stay safe and have a great holiday season.